Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Edition of Zacks Top Stock Picks. I am Brian Boland, the aggressive growth stock strategist, and I'm going to have a top stock pick for you. But right after me is going to be Nina Mishra. But first, here I am on Dave Bartosiak's porch, and let's get right to my top stock pick for the week. It's CarMax. So CarMax is my pick here, and you can see it. The ticker is KMX right up there. KMX. It's a Zacks rank number 3 with the C for value, an F for growth, and strangely an A in momentum. So why is this my top stock pick for the week? Well, as you can see right here on our first page that you come to when you're looking at a new quote, you can see the earnings date, and that's later on this week. I think it's going to be, before the market opens on Thursday, last day of the week, or close to it, right? So what's been happening with CarMax is we can see from the chart year to date, stock moving down, miss. There was a beat right there. I don't want to say it's all been misses, but what that is a pattern right there. Let's take a look at some of the things we often look at here. Anytime I look at a stock, I always shoot to the earnings history. That's probably the first thing I look at, and then I try to blot it out with a gigantic blotchy circle. So we got a beat, a miss, a beat, and a miss. So maybe we're due for a beat next. But we can see here that the misses are much bigger than the beats, and that gives us that negative 16% average earning surprise. Let's take a look at estimates. What have they been doing? We're just going to go through this really quick and ugly. They've been trending the wrong way, right? Here we can see 78 to 61 isn't good. 78 to 67 isn't good. 429 to 391 isn't good. And this one isn't quite as good, but quite as bad, I guess I should say. And then let's take a look at sales. How have sales, we've been thinking about sales. You got to have sales to grow estimates unless you're cutting expenses to zero. So slowing sales this year, next year slightly up. So it's kind of a wash, but it's a big number on sales there, 31 billion. Let's take a look at our valuation metrics, and then we're going to go to the chart that I think will give us a better explanation. 15 times earnings with little to no growth is a little, it's right on that edge there of being exciting but not exciting. Price to book, well down there. Price to sales, way down there. Margins here, pretty thin. So you got thin margins, a decent size multiple, and slow growth. So what is really going on? I'm going to hopefully explain a little bit. So here is the Manheim Used Vehicle Value Index. Earlier in the year, we saw this number shoot straight up, and that was a number of things there. There was no inventory for new cars, so used car values skyrocketed, post-pandemic sort of stuff. So what has changed? Well, the number, we see the value of used cars going way down here. And new vehicle inventory, from what I'm understanding from the things that I'm seeing, is up quite a bit and at normal to above normal levels. So if you need a car, you need to go buy a car, and you have to get one, you're going to be able to buy one and get it today is basically the idea, depending on where you live. And that is going to hurt used car sale, values, because they were artificially super high. So now they're really going to be coming in, expect them to come in a little bit more because, that's just how these things happen. But, who's going to benefit from that sort of thing? And clearly, I believe that the CarMax people that have these cars that maybe were sitting on the lot for the last 5 or 6 months and went unsold could see a huge surge now that the prices are coming in. The question is, how much do they come in, and at what level are people demanding, new cars? So that is the thing I'm looking at, and that's the reason why I'm going to pay close attention to this earnings report from CarMax. So let's take a final look here at our stock price chart, and we can see the earnings estimates for this thing have just been coming straight down like that. But at some point, are we going to reach this sort of bottom right here? And I think we're pretty close to that, reaching that, and then I think we'll get back to the pattern of a lot more beats than every other time, missing and beating and missing and beating. So let's look for a positive number, despite the fact that there's such a big negative ESP for the EPS for CarMax. Well, that's it for me for this time. I'm going to pass it off here to Nina Mishra to see what she's got for her top stock pick.
Thanks, Brian. I'm Nina Mishra, and my top pick today is Signet Jewelers, ticker symbol is SIG. So Signet is a leading retailer of diamond jewelry. They own K Jewelers and Zales, and also recently acquired Blue Nile. So the stock surged recently after the company reported excellent results, beating on both the top and bottom lines. And they also raised their guidance. And this comes despite a very difficult economic environment where many customers are cutting on their discretionary spending. But K Jewelers is now focusing on high-end consumers, and we know that high-end consumers are not much impacted by the economic weakness as of now because the labor market remains very tight. So this is what we have seen from some other luxury retailers too. They reported that high-end consumers remain rather resilient. So currently about 1/3 of Signet's sales are to what they called accessible luxury items. So that is one of the main reasons why the company has been able to do well despite these tough economic despite this tough economic environment. Now let's take a look at some of the charts by going to the quote page on Zacks.com. So Signet Jewelers, ticker symbol SIG, as I mentioned, is currently a Zacks rank #1 strong buy ranked stock. B for value, B for momentum, but for growth. Now, as I mentioned, they had reported excellent results recently. So if you look at detailed estimates tab, you will see this big surprise of almost 150%. Their earnings were more than double the estimates. And that is the reason why analysts have been raising their estimates for the current year and the next year. Both have gone up significantly, and that is the main reason why the stock is currently a Zacks rank #1 stock. Now, if you look at the more longer term price consensus and EPS surprise chart, you see all green arrows. That means the company has not missed even once in the last 5 years. It's a very impressive record of beating the earnings estimates quarter after quarter after quarter. Now, one more thing I wanted to mention about this company, that in 2018 and then in 2021, they had adopted strategic plans to reduce their costs, improve profitability, and also improve online sales. So those plans, the implementation of those plans appears to be working, and that is what we saw from the recent results. So the Zacks rank #1 strong buy ranked stock is definitely worth a look. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer. And also make sure to subscribe to our videos so that you do not miss anything. And we will see you with 2 more top picks next week.